Thorsten Slock of Apollo, one of the two best economists on the planet right now. There's only three that I pay any attention to at all. And Slock is at the top of the list, mainly because he's been really right about a lot of things. Now, he came out, and he's at Apollo. So he came out this morning with a list of 7 questions that investors have to be asking themselves right now, because the implications with the market where it is, and understand he's pretty bullish on business and the economy. It was like, he brings up a couple great points. So I want to share them with everybody here.
Okay.
First, total federal employment, including contractors, is about 10 million. How long can Doge continue to pull off these related firings? Remember, you've seen the agency firings, some of them. You haven't seen the knockoffs out to the contractors yet. Could this create a recession? How are the markets going to respond if we start seeing 300,000, 400,000 jobless claims on a week-to-week basis? That's an interesting question, and it's one that he's not the first one to bring it up. It's front and center on a lot of minds right now.
Yeah, and actually, is not to interrupt you here, Tim, but I'm going to give our group and hosts here a pat on the back, because this is actually something that we've been talking about for a couple of weeks here. If the job numbers really start to, or if the unemployment numbers really start to become crazy, what's that actually going to do for the market? So it's not just some of the economists out there. There are others thinking about that too.
Now, the other question, and this is where, you can criticize Jerome Powell all you want, but I've said this for a long time. The worst $200,000 a year job in the history of $200,000 a year jobs is Fed chair. Because now you've got, can Doge cause a recession? Next question. If inflation remains sticky, and it certainly looks like it's going to, and the Fed does not hike, what happens to long rates and break-evens in the bond market? What does that mean for stocks? Mm-hmm. It's probably not good. Okay. Now, next, what happens to the debt ceiling in June? Don't think about this one too much. You'll lose sleep because wow. I mean, it's not that the two sides fall apart. The fractions inside the two sides are far apart. So, and a debt ceiling, like it or not, we've got a bunch of auctions coming up between now and June, and they're going to be impacted by what's going on with the debt ceiling and the debt ceiling negotiations. Okay. Then, and this is one that I've talked about. We're all concentrated in the S&P 500. We're super concentrated, okay? Now, for those of you that think that's normal, it's not. The last two times we were this concentrated were 1999 and 2009. I'm sorry, 2007. You guys do the math, right? Nothing good happens when you're this concentrated, because much as it was one line and one earnings report that started all of the free fall, use better words than the one I had in mind there, back in 2000. Say OpenAI did an IPO and it flopped, or we get an earnings disappointment from NVIDIA, or something goes wrong with any one of these leading AI companies, or China comes out with something that relapse around everybody, like DeepSeek already took a lap. Mm-hmm. So, what if they stole a bunch of stuff and made it even better? Because remember, the Chinese tech sector did depend in large part for years on stealing our stuff. But then we did something really stupid. We educated all of their data scientists and then sent them home. That's never really made sense to me, but we did it. So they've got some really smart people working on all the stuff they stole. What if they get better and they get a lead on us? Okay, what happens if all these super high tech stocks start to fall for any one of a number of reasons? What happens to the broader market? The next one, and this is another one, if this one could increase liquor consumption dramatically. Who will be the next Fed chair when Powell's term ends in 2026? Because it ain't going to be Powell.
Yeah, this is another. Tim, I absolutely love what you're doing right now. This is another discussion that we've had in the happy hour, kind of going back and forth. And first of all, I'm completely with you. There's no way Powell does this again. No chance.
Well, no, it's even if he wanted to, and you have to be insane to want to. The president's not going to let him. That's just, there's no way. These newsflash, in case y'all hadn't figured it out yet, these two guys don't like each other at all. So what does that mean for the market? Because a rubber stamp in the White House, a White House rubber stamp at in the Fed is not good for markets. Okay. Whether you hate the Fed, want to end the Fed, burn the Fed, audit the Fed, buy the Fed some roses, it doesn't matter how you feel about the Fed. In the world we live in, an independent Fed is necessary to the proper function of the economy and the markets. You can argue till you're blue in the face, and all I got to do is just point to the global economy, and I win the argument. We can't function without it. If you rubber stamp it, the last rubber stamp was a fellow named Arthur Burns. He is an ugly, ugly asterisk in the history books, because when Nixon told him to cut rates in spite of the data in the early 70s, he did it. Just go back and look at the chart and you'll see what happened. It wasn't good.
And we don't want to repeat.
We don't want to repeat that. And then
sure.
The other one, and remember, if you go back and you look at what Volcker did, raising rates up to where, he briefly touched 20% to fight inflation. He fought with first Jimmy Carter and then Ronald Reagan all the way up until they finally broke the back of inflation. And then the next one is, and this is an interesting one. I'm dying to see how they do this, because previous two administrations, I'm going to put the blame where it really goes. The stock of T-bills outstanding is at a record high as a total share of debt. Are we going to fix that? And how are we going to fix that? Because somehow we've got to shift some of that short debt out the longer end of the curve. Nobody wants to buy our longer bonds right now. So it's an interesting problem. And then you've got to be thinking, we've really segmented the planet in terms of trade, technology, security. What implications does that have for developed markets, for the United States, for emerging markets? Everybody looks at this and everybody hates China. In China, they got the real estate problems. They got these problems. They got that problems. Chinese markets are screaming higher, especially tech stocks. They're crushing the S&P 500. So while everybody was down on China, all of a sudden that market took off. Where's the next market to do that? Sorry, that's just 7, I thought, very cool questions.